Are you ready?
Ready.
All right, let's go. Kevin here, top 1 financial advisor and best-selling author. We are here to talk about the stock market. Hey everybody, I know that normally I post these videos around 7:30, sometimes 8 o'clock. I had a lot of work to do that I had to get done, and I still want to go ahead and put out my video. So apologies, because it's like 10 when I'm recording this, so it'll be probably closer to 10:30 or 11 by the time it get posted. But trust me, the things that I've been working on this week, you are going to enjoy. So it's going to be about 2 to 3 weeks before all that stuff releases, and I'll let you know when those things come out. But today we need to talk about a bear trap. What is it and how do you navigate it? Because there are plenty of people who think that we are in a bear trap right now. So what is a bear trap? Remember, when the stock market is down 20%, we call this a bear market. And for 2022, prior to July, that is exactly where we were. We're down. In fact, the market was down as much as 23%. Then July happened. The market was up and went from being negative 23 to negative 13. That is a huge difference. And I was glad. I think we're all glad that we saw a good month. Best month since November 2020. I've talked about that before. But now, what happens, right? In August, the market isn't all that great. I think we are up about 0.5%. And is the market going to continue to fall? And this is where that bear trap starts to happen. Now, in recent memory, there have been 2 bear traps. There was one in 2008 and then one in 2002, so 2002. And I want to show you that real quick, and then we'll talk about a way to navigate this. So I'll put this up on the screen right now and just show you a chart of, again, what this looks like. So we go back to 2002. The market was bad. This is the dot-com bubble, and what we're looking at here is just the S&P 500 and then the S&P 500 index fund, SPY. And first, you will see here, this is July 23rd, 2002. The market came down, and then it shot up. That was a bear trap. Say, look, I think this is the bottom of the market. Everybody says, like, hey, we've hit the bottom. Now it's time to invest. I think things are going to be fine. And then you move over to August, which is right around now of 2002, because today is August 25th. This is August 23rd, where you hit the top. And then the market continued crashing and went all the way back down, back to where it was in July, in October of 2002. I guess it is 2002. I keep saying 2002. Y'all get the point. And this is how we get to this situation, because it's very similar. Very, very similar. July was great, and then where are we headed now? It's just that trend has not continued. And what happens when you are unaware and you don't know how to navigate this, a lot of people wait, right? There are a lot of people complaining, market's terrible, president's terrible, everything's bad, this is all a scam, right? And everybody's selling their shares, and then July happens, everybody comes back into the market in July. And then the market just kind of falls back off. So how do you navigate this as an investor? There are 2 ways to look at this. Number one, you probably already know what I'm going to say. You can dollar cost average. You can just continue averaging your investments, and just, whether it's every Friday, 1st to 15th, whatever that thing is going to be, I say all the time, stay on your consistent schedule. Because if you want to buy at the bottom and get the best price, you might as well just keep buying, because you would have caught it in this case in 2002. You would have caught it in July. You may have bought at the top in August, but you also would have caught it in October. And over time, when you average that out, you're going to perform quite well. But it works over time. One thing that I do, and I take just a little bit of a twist on this, and you'll notice that if you're in the members only, you'll notice this, that I pick and choose certain spots while I'm buying stocks, and this helps me to lower that cost basis. It helps me to buy at the bottom more often than not. And if you have paid very, very close attention to my portfolio and paid very close attention to the members only, you'll see that there are some weeks where I didn't buy any stocks specifically. I'll just say, look, I'm just going to put some money in my S&P index fund, but I'm not going to try and snap up a stock, because there haven't been any great deals. And notice, if you scroll through my timeline, and it's a lot of scrolling, but if you scroll through my timeline, especially on Fridays, in July, go back and look, you'll see I didn't really make a whole bunch of purchases. You saw me make a whole bunch last week because the market was down, and those are the prices that I wanted to get. But in July, I didn't do that. And if you look at how the market has performed, it's really the opposite. And this is where people get kind of caught off guard. So for example, if you are looking to buy Amazon, okay, Amazon, I have it written here. So a company like Amazon, they're down 18% for the entire year. Now, normally, if you took the name Amazon off of, you're like, I don't know if I'm going to buy a company that's down 18%. But now it's up 18% over the last month. Obviously, this factors in July and much of August. That's kind of a trap, because if you are going to buy Amazon, you want to get the best price and the best return for Amazon, you wanted to get it before July. You wanted to get it when it was low, because now it's a bit higher. Could it continue to ride out and do well? It certainly could. But if I'm looking to get the best price, I wanted to get it when it was low. Take, on the opposite side of things, take a company like Eli Lilly, which this entire year is up 17%. It had been quite good this year compared to where the market is. But this month, or over the past 30 days or so, it's down 2 to 3%. Now you're looking at doing the opposite. So if you were into a healthcare company, which we have been talking about, like Eli Lilly, this would be the time to buy, because this is that discount season before the market starts to rise again, whatever that may be. But you're looking at trying to find the best prices and understand where the market is going as a whole. So when we talk about buying low, selling high, you have to understand, whether it's using a chart or using whatever process you use. We use a chart and we talk about it in the members only. You want to try and gauge, these are the prices I want to start to really buy in, and as the market is going up, I'll sit and wait until the stock comes to me. Okay, and that's something that we talk about all the time in the members only. I say, look, the price is here. I need it to come down to, I'm just making a number here, $100 a share or what have you. This is when I'm going to buy it, because I want to get my average low. I want to buy at those specific dips. And there weren't that many dips in July, which means I didn't make a whole bunch of purchases in July. So you want to be very careful. So those are the two ways that you can survive a bear trap, and this sets up to be one. I'm not going to come out here and tell you this is absolutely a bear trap and the market's going to continue to fall. I don't know that. Okay, can't predict the future. What I can do is help you to navigate what is currently going on. So be aware that it could be a bear trap. That we had a great month last month. This month is barely over 1%, and we'll see. It's still a midterm year. We'll see how that happens. There are still some struggles. Inflation is still a thing, so we will see what happens there. Okay, but those are two ways you can navigate it. Dollar cost average straight through, that's the easiest thing to do. Or you can start to gauge and understand how to read charts and decide, what are these dips, what are these price levels that I'm going to start to buy in to help me to get a better return and understand the right times to get in. Okay. All right, so that is it for me. If you want to learn how to understand these charts and see how I use this process to buy and sell, then you want to do it in members only. Okay, this is exactly what we talk about. I do at least one video per month for our members where I show you exactly where I am buying and how do I look at a chart and decide, hey, when it comes down to X price, this is when I'm going to buy. It's one way how, even if a stock is down, or sometimes take like a Dollar Tree, for example. And I think Dollar Tree, when we had talked about it last week or so, and they announced earnings, so these numbers are quite different today. But Dollar Tree was up like 10%, but I was up 13%. Why was that? Because I bought it at those specific dip points, so my average price was lower, and when I buy at that lower price, as the stock goes higher, my return is larger than someone who just bought at the very beginning or just dollar cost average. So that's one way, just one way that you can navigate a bear trap. It's the most profitable way if you can do it correctly. So if you want to learn more, check out the members only. We have another fresh video for y'all tomorrow at our regular time, and now I'll be releasing a new video for our members only tomorrow as well. All right. That is it for me. I'll talk to you later.